Let's bring in Julian Callow, Chief European Economist at Barclays Capital in London. Julian, glad you could join us this morning. As you well know, this is supposed to backstop Greece's borrowing in the public markets. Let's start with this question. Are bond investors going to bite?
I think already they are starting to bite here, and I think we will probably continue to see that process. I would really stress that this is a very important milestone that has been passed in European economic history here. We have the countries coming together, able to help to provide assistance to one of their number in the euro area. The numbers are very, very large. The amount of aggregate financing that's going to be made available, up to 30 billion euros, potentially that could be higher still. The interest rate as well is on the low side in relation to current market rates, although it's still on the high side in relation to Greek nominal GDP expansion. And we have the IMF there with its additional 15 billion euros as well. So I think it's a defining moment, one of these key moments in European monetary union. There are still details that people will want to see in the financial markets, such as what kind of creditor status do these loans have from euro area governments? How does the IMF creditor status stack up in relation to that? What exactly would trigger a call on these lending mechanisms? But in terms of the overall size, you've got to remember that Greece needs to issue something between 12 and 17 billion euros by May the 19th. Once it's past that hurdle, which is when the big refinancing happens, then it should be relatively straight sailing in terms of issuance for the remainder of the year for Greece. But in relation to that, the amount that's been laid out as potentially available of up to 30 billion euros within the next year for Greece certainly is itself very helpful. As I say, there are just some more details people will continue to want to see on the creditor status, and also people will want to see on Germany on the political side. Yeah,
Julian, it sounds like you have quite an optimistic view over Greece's borrowing, and it certainly sounds like you're giving this deal a ringing endorsement, a defining moment, an important milestone. But by the same token, does it not institutionalize a bit of moral hazard here for the EU stepping in to bail out Greece? And one would have to assume any other country, borrower that member of the EU that requires similar assistance.
Well, that's right. And I think there's still a big story to be told on what lies behind this agreement, because, as you're saying, Germany in particular was very concerned about moral hazard risks. And it's been very clear that Berlin, and particularly Chancellor Merkel, have actually been insisting on some reform of the Stability and Growth Pact. So I'm waiting to see what kind of quid pro quo might have emerged as a result of all this. Germany has been one of the best behaved countries from the fiscal side, particularly of the large countries that we've seen since monetary union began. And I don't think it's going to be very willing to sign up to this unless it gets something meaningful in return in terms of a tightening and strengthening of the Stability Pact.
But has Germany not already signed up to it? I mean, does the EU agreement not indicate that Germany has signed up? And in fact, if in fact Germany has signed up, doesn't that mean that Germany has effectively lost all of its negotiating leverage against countries like Greece?
I don't think that's true, if I may say so. Germany has signed up to the principle of the agreement. At the same time, it's still possible that Germany might not sign over funds if it didn't feel that there was sufficient progress going on here. It does appear that there is some latitude, although this remains to be seen, but it does appear that there may be some degree of latitude for a country still to step out of the lending, and in other words, force Greece to be more reliant on the IMF. The IMF is another interesting angle here, because you have the IMF potentially being called on for Greece. You have the European Commission, the European Central Bank, all the other members of the euro area. This, I think, gives the Greek fiscal consolidation a lot more credibility still, on account of the credibility that all those institutions combined would have if they were to be providing this very exceptional lending to Greece.
Julian, to the degree that there is latitude for countries like Germany, does this or does it not put to end questions over the integrity of the euro?
I think if you consider what the alternative is, which is to do kind of nothing along these lines or just call on the IMF, then this is certainly a significant step forward. As we know in financial markets, if you reduce uncertainty, then you are actually going to have a more positive outcome. This certainly does increase visibility, increase what we can see about the outlook for Greece.
Julian, thank you so much. We have to run, I'm afraid. Julian Callow, Chief European Economist at Barclays.